All right, today we're cracking open the playbook of a young Warren Buffett. We're going back to his 1964 partnership letters to deconstruct the three-part framework he used to systematically beat the market. This is the very foundation that built the entire legend. This one quote, it's really the key to unlocking his entire philosophy. It's not about whether you're up or down in absolute dollars. No, for Buffett, success had a totally different and much clearer definition. The only thing that mattered was how he did compared to one single benchmark. So here's our roadmap. First, we're going to define that all-important yardstick. Then, we'll see how the so-called pros on Wall Street stacked up against it. And finally, we'll dive right into his three core investment pillars with some real case studies that show you exactly how he put his money to work. So let's really get into this because it's so fundamental. Buffett made this powerful argument that the only honest way to judge your performance is against a standard you decide on before you start. The daily mood swings of the market? Totally irrelevant. All that mattered was the final score against his chosen opponent. So what was this all-important yardstick? Well, it was the Dow Jones Industrial Average. And he picked it for a really simple reason. It's the result anyone could get by just sitting on their hands and doing nothing. It was the baseline. And as we're about to see, it was a baseline that most of the highly paid experts couldn't even touch. And here are the results. Look at this table from his first 7 years. You can literally see how his partnership's performance didn't just squeak by the Dow. It created this massive, ever-widening canyon between them year after year. Let's just zero in on the final number, because it's pretty wild. Over those 7 years, Buffett's partnership compounded at 27.7% a year. The Dow, 10%. That created a staggering 17.7 times percentage point average beat over the Dow every single year, a margin he himself called unattainable over any long period of time.
Okay, so Buffett beat the unmanaged Dow. Big deal, right? Well, what about the professionals, the high priests of Wall Street, as he cheekily called them? He tracked the 4 biggest mutual funds of that era, who were managing billions of dollars, against that exact same benchmark.
This chart just tells the whole story, doesn't it? Over on the left, you see Buffett's partners making over 22% a year. In the middle, there's the do-nothing Dow, chugging along at 10%. And on the right, the best of the 4 biggest professional funds, they couldn't even keep up with doing nothing. They came in just under, at 9.7%.
And Buffett, he was never one to mince words. He pointed out that this failure wasn't just a fluke. The data proved it. The huge, highly paid investment industry was, as a whole, failing to justify its own fees when compared to a simple, passive index.
Okay, so that's the what. He beat the market, but the real question is, how? How in the world did he actually do it? Well, the answer is in his investment framework. He had this brilliant way of organizing his portfolio into 3 completely distinct categories.
He broke everything down into 3 buckets. He called them generals, workouts, and controls. And this wasn't just some neat filing system. No, this was a powerful mental model that let him understand exactly how each investment would probably behave, giving him this diversified engine for creating returns. So first up, you've got the generals. Think of these as your classic meat and potatoes value stocks. These are just companies trading at a big discount to what a private business owner would logically pay for the whole thing. Their performance usually moved with the market, but that cheap price gave him a huge margin of safety. Next, you have the workouts. Now, these are totally different. Their profit was tied to a very specific, publicly announced event, like a merger going through. The outcome depended on the deal getting done, not on whether the stock market was going up or down. This gave him a steady, predictable source of profits. And finally, the really interesting one, the rarest of the bunch, controls. This is what happened when a general, one of those cheap stocks, just stayed cheap for so long that Buffett's partnership could actually buy up enough to take a controlling stake. This is where he shifted from being a passive investor to an active owner who could force the company to unlock its value. All right, enough theory. Let's look at a real-world example. Here's a classic workout he wrote about: the buyout of Texas National Petroleum. The deal was announced, creating a clear, predictable path to making a profit. And when you look at the timeline here, you see a really important lesson that Buffett stressed. See how it was supposed to close in August? Well, it actually dragged on until late October, and the payout stretched into the next year. His big point? These workouts almost always take longer than you think.
But here's the kicker. Even with all those delays, the investment generated an excellent annualized return of about 22%. Why? Because his money wasn't tied up for that long, and the outcome was pretty much a sure thing. It was an incredibly efficient use of capital. And that's the power of the workout. Okay, now for my favorite category, the one that really shows the genius at work, the control play. Let's talk about Dempster Mill Manufacturing. This thing started out as just another cheap general, but over 5 years of patient buying, it morphed into a full-blown control situation. I mean, just look at this before and after. It's insane. After taking control, Buffett hired a manager named Harry Bottle, and in less than 2 years, they took $4 million of useless, stagnant inventory, literally just stuff sitting in a warehouse, and turned it into over $2 million of stocks and bonds. They literally turned dust into cash. And the strategy was just ruthless efficiency. Harry Bottle went in there like a surgeon. He slashed costs, shut down branches that were bleeding money, and got rid of unprofitable products. He took all this dormant capital that was weighing the business down and turned it into a cash-generating machine, fundamentally rebuilding the company's earning power. So, after going through the numbers and the strategy, what can we as investors today actually take away from all this? What are the timeless principles that are just as powerful now as they were back then? Well, first and foremost, it's the incredible, almost magical power of compounding. Buffett loved using this story about the Mona Lisa to make his point, but this table really brings it home. Look at the 30-year mark. That jump from an 8% to a 12% return doesn't just add 50% to your money. It more than triples it. Tiny differences in your rate of return become absolutely gigantic over time. And that really boils everything down to these 3 core ideas. Number 1, you have to measure your results against an objective yardstick, not against your feelings or the day's headlines. Number 2, patience isn't just a virtue, it's a strategic weapon. Remember Dempster Mill? That took 5 years. And number 3, skin in the game is everything. Buffett wasn't playing with other people's money, he was playing with his and his family's money. Everyone was in the same boat. So we'll leave you with this question, which comes from the man himself. He knew that his early, absolutely spectacular returns weren't sustainable. He even wrote that his 17.7% margin over the Dow was, and I quote, unattainable over any long period. Just think about that. It's a powerful reminder to set realistic expectations and stay focused on the patient long-term game.